everyone, and welcome. My name is Leon Wessels, and I will be the moderator for today's session. I'm pleased to have Michael Brohan with us today, who I will be introducing in just a few minutes. For those of you who do not know me, I have been associated with trust-owned life insurance for the past 20 years with Insurance IQ, Insurance Trust Monitor, and now with Life Insurance Trust Company, which is among the ITM 21st family of companies. I have come to know many of you over the years, and we are pleased that you are joining us today. On behalf of my associates, John Barkhurst and Joe Gausted, who, by the way, are responsible for making these events happen, we thank you for attending and we welcome your feedback. I want to give a shout out and recognize a couple of groups. First, I want to thank the Michigan, North Dakota, and Iowa Trust Associations for promoting our webinars to their members. I also want to recognize Truist Bank, which is SunTrust, BB&T, and Crump, City National Bank, and First Financial Bank for having the most attendees by company joining us today. Thank you for attending. When we get this type of participation, it makes it all worthwhile. It keeps us motivated to continue providing quality speakers and informative sessions. Please pass the word around as we have room for more. Today's session is the second webinar since the restart of the ITM 21st University Education Opportunity. If you find that your time was well spent and the information helpful, please share your experience with your friends and colleagues. As I said, we do want to have as many people participate as possible. If you're not already signed up to receive our weekly blog, you can do so from the ITM 21st website. I believe you will find the information timely and useful. We are using the GoToWebinar platform for our sessions. Each will be recorded and available on the ITM 21st website under the Education tab. The phone lines will be muted during the session, except for those who are listed as panelists. I encourage you to ask questions via the questions chat box that is on your screen. We have allocated time at the end of the session to answer any questions that come up. So please, again, help us make the event interactive by submitting those throughout the presentation. John Barkhurst will be monitoring those today, and we'll open up the lines. I think we have Aaron Hansen and we have Mike, and so we'll have plenty of people who are capable of responding to your questions. If you have a question that you want to remain private, please indicate that, and we will respond via email following today's meeting. The continuing education slide, what credits and how to get them. All of our sessions are free of charge, even for those seeking the continuing education credit. All webinars are submitted for 1 hour of CTFA and CFP credits. For those of you who are members of the Fiduciary Investment Risk Management Association, better known as FIRMA, you may also receive credit for today's session. If you're not familiar with FIRMA, I encourage you to visit their website to learn more about the fantastic organization. They are located at www.thefirma.org. To receive your continuing education credits for today's session, please click the download. That form is on your screen. You can click it and receive it from there. Or if you cannot locate that or have difficulty, you can download it from the ITM 21st website education page. Please complete the form and return it to the ITM 21U at itm21st.com within 7 days. If you have any questions about credits, please send an email to the same address and someone will respond as quickly as possible. 2 weeks ago, we had 29 requests for CFP, 66 requests for CTFA, and 9 for FIRMA credits. Considering this was our first event in a couple of years, it went well in terms of requests for credits with just a few hiccups. A couple of request forms were missing license numbers or the last 4 of the Social Security number, depending on the credits you were seeking. Our associate Joe Gausted took the initiative to follow up with those who had requested credits and saw that all the information was complete. If you have any questions or need assistance, please let us know. It's great to see that today we have 32 CFP requests, 78 CTFA requests, and 9 FIRMA requests for credit out of 204 registrants. So for faculty, pictures, and again, I'm pleased to have Aaron Hansen, Michael Brohan with Your Life Insurance Solution, Judith Pearson with Nomadic Solutions, and John Barkhurst, of course, who provided our last presentation. We will be scheduling guest speakers coming up this summer, Lloyd Poole and Kevin Mods from Poole Consulting, and Rachel Green from Team Risk Management Strategies. Our webinar schedule. So after today, we have a session that I'm excited to to participate in with Judith Pearson on May 27th. Judith is the founder and CEO of Nomadics. She'll be discussing minimizing trustee liability in the changing market. On June 10th, we've got Michael Brohan back with Aaron Hansen, who will provide an in-depth session on Trustees Guide to Life Settlements. And I got to tell you, there's some crazy stuff that I've seen recently in this area. It'll be fun to share that with you. On June 24th, we'll have Directed and Delegated Trusts, the risk of confusing the two, presented by Kevin Maas with Pool Consulting and Training Group. Slide 5, continuing my tradition of last session, The Winner's Minute by Mac Hammond. Americans have been living in what feels like an altered reality for over a month now. Because of that, frustration has had plenty of time to fester. That's why it's important we stop focusing on what frustrates us and instead focus on the good that is happening today. Consider all the people whose lives have been saved because we flattened the curve through social distancing. Consider the kindness that's been given as people reach out to help others. Yes, negative news has been prominent, but let's focus on promoting good news. If you don't know where to start, perhaps change your source of news. But be positive, good things will happen. Today's speaker is Michael Brohan. Michael's a pioneer in the trust-owned life insurance world. Michael now works with trustees and wealth advisors nationwide, helping them navigate the life insurance marketplace. His time in the TOLI world taught him the benefits of developing prudent practices to buy and sell life insurance. His ability to bring clarity to a confusing marketplace allows his clients to move forward with confidence. Michael has enjoyed educating peers about life insurance, especially in the trust, accounting, and legal community, and has been a speaker at numerous national events. In 2019, he published his first book, The Wealth Advisor's Guide to Life Insurance. I'm going to take a quote from the Farmers Insurance Group commercials, which says, "We know a thing or two because we've seen a thing or two." And that applies to ITM 21st and Michael Brohan as it relates to life insurance policies held in trust. If you ever have a challenging situation and do not have a plan to mitigate the problem, please reach out to your ITM 21st remediation specialist. And if you're not an ITM customer, feel free to contact Michael Brohan directly, as he is an independent TOLI consultant. And Michael's contact information is on the screen as well as the front page of today's handout. And so with that, I turn this over to Michael Brohan.
Okay, thank you, Leon. Let me get my slides up here. Well, I want to thank Leon Wessels and John Barkhurst and Aaron and everyone at ITM 21st for the opportunity to talk to you today. And those are great thoughts from Leon, because what we're going to talk about today is really unprecedented. I'm getting some feedback, Leon. Do you hear that?
Maybe just John, can you hear feedback?
There's a little bit, Mike. Maybe just back it up a little bit.
Okay. Anyway, those are great thoughts from Leon. You know, these are unprecedented times for everybody, and it's important to highlight the humanity of what we're going through right now. The discussion today is going to center around life insurance and the management of life insurance. And as you're going to see, coronavirus is a big issue right now, and it's caused a big insurance. The last decade or so of low interest rates has been the real issue. As Leon mentioned, my background really is in life insurance. I help wealth advisors buy and sell life insurance. I am a CFP, so I am a fiduciary like many of the people that are on this line. So all of us are trying to do what's best for our clients. And I mention this because doing the right thing is often hard, not necessarily because you do not want to do it, but because maybe you don't know how to do it. So today's focus is going to be on gaining the knowledge to do what's right for the client and then putting that knowledge to work in a process. We're going to start by talking about the marketplace today. What is happening for your clients looking to purchase life insurance today? And then we're going to focus on the management of life insurance, because I know there are a lot of trustees on the line that are looking for tips in this area. And in that vein, we're going to talk about one thing that trustees can do to mitigate their liability. And that's going to roll into a discussion on finding the best policy. And that's going to relate to how you can mitigate your liability when the policy comes in. And then we're going to talk about a process for dealing with an issue or a request that I think you're going to see more often in the future. And then we're going to end with a Q&A, and I'm hoping we get some good questions along the way. And then I quickly want to showcase an offer for those who are interested in learning more about life insurance. Because there was so much information, as Leon mentioned, there is a handbook available. I'm not going to be able to get into great detail on everything, but I wanted you to be able to have a reference to take away from today's session. So there is a handbook. Please download it for reference going forward. So let's start with this, because I've been asked this a million times in the last couple of weeks, and that's, is my policy okay? Is my carrier okay? What's going to happen with life insurance carriers? In other words, will the pandemic itself create issues with the carriers? And the simple answer is no. The increased mortality that we're seeing because of the pandemic will not by itself cause an issue. And there's a number of reasons for this. The first reason is there are two major risks that life insurance carriers have. The first is mortality, that insureds will pass away sooner than expected. But the second risk is longevity, because most carriers that sell life insurance, they also sell annuities, and typically people annuitize annuities to pay an income stream over their lifetime, and that income stream stops when they pass away. So carriers have a built-in diversification that allows their risk to be offset by these different products. The second reason is that most of the people who have passed away are older, and so if they're insured, they probably had policies for many, many years with high reserves, or if they purchased a policy more recently, they had a policy with pretty high premiums. And I'm not trying to sound callous here, but this is just one of the realities. Many who have passed away also had secondary health issues, which would have probably made them uninsurable, or if they were insurable, they were rated, which gave them even higher premiums. And the third reason is that carriers share the risk in a death benefit. If your client buys a $5 million policy, chances are the carrier they purchased it from is sharing that risk with another company. And these reinsurers allow the carrier to diversify risk again. And this is not just for life insurance. It happens with all types of insurance. Hurricane insurance, for example, is one where a lot of the risk is reinsured and spread across a number of carriers. The fourth reason is that accidents are down. The fact of the matter is that every year, 150,000 people in the United States die from accidents, about 35,000 from car accidents alone. And we've been limiting travel in the United States for a couple of months now, and this has had a big effect. And that's why you see some car insurance companies giving money back or reducing premiums to their policyholders. So risk rising in one area often causes risk to fall in another area. The bottom line is the increased mortality caused by coronavirus will not affect the stability of carriers. If your carrier was stable before the pandemic, it's going to be stable after the pandemic based on what we see now. But how has it affected new policies, the ability of your clients to get new coverage? Believe it or not, there are some pluses that have come out of the pandemic, but it's definitely had a lot of negative consequences on new policy purchases. The first thing is some carriers are pulling products from the market. But while one carrier, for example, pulled a 30-year term policy, another one rolled out a very similar product. So there is some give and take in the marketplace. Earlier this week in the Wall Street Journal, Leslie Schism had a great article that highlighted some of the issues in the life insurance industry. And the article focused on the price increases in the market and mentioned one carrier raising rates 8 to 12%. And she mentioned in the article that the reason the carriers are limiting products and raising prices was the collapse in interest rates tied to the spread of coronavirus and the expectation that these rates won't rebound significantly anytime soon. So most of the issues are on longer duration products, especially those that have guarantees. So if a carrier can put out a product where they can control the crediting rate and they can control the cost of insurance inside that policy, well, that's one risk for them. But if you have a carrier that has a 30-year term policy with guaranteed rates for 30 years, or a guaranteed universal life policy that's going to guarantee that product for life, then you have a different situation. And those are the areas I think we're going to see are the most hit. So the risk for the carriers is locking into a product with guarantees when they're worried about interest rates. And in the article, Leslie had a chart that showed carrier investment portfolio yield that was pulled from industry sources. And this showed the drop in yield over the last 30 years for carriers. So if you look at the chart, in 2019, the yield was 4.4%. That was down a full percentage point from 2010 and down 4.5 points or so from 1990. Our rates have been dropping continuously. In 2019, the rates were 4.4%. But the question the carriers have is, will this keep going? So their pricing decisions for now, and the trend is that prices, at least on some products, will have to go up because these rates they feel may at least at best level out, but probably go down. So one of the things I want to point out is that underwriting is extremely important now if you have a client who's looking for life insurance, because if your client can get a better underwriting offer, they might be able to offset some of the price increases. The better your underwriting offer, the better your pricing is going to be on the policy. So if you have a client looking for a new policy, make sure that they're working with someone who has a good underwriter working with them, one that knows the life insurance market, because what happens is some carriers are better at some issues, some health issues than other ones. So if you have a good underwriter, they know where to send that case in order to get the best underwriting offer. And that makes a lot of difference in pricing. Carriers have actually been forced because of the pandemic to make some changes in underwriting. And one of the things that's happened is something called accelerated underwriting has been increasing. And accelerated underwriting is something where instead of a face-to-face paramed, what happens is your client calls the carrier, they take the client's information, and if the client is healthier, and if the client is typically younger, and if the client is asking for less than $1 million, they can get life insurance simply by having the carrier look at the Medical Information Bureau, prescription database, and their motor vehicle records, rather than doing any face-to-face paramed. Now, again, this type of underwriting is really for younger insureds. But if you have somebody who just got married, somebody who just had a baby in their early 20s, it's very, very quick and easy to get life insurance if they're healthy. And this is a great thing for consumers. And for the older age insured, what's going to happen is these types of efficiencies are going to help speed up the underwriting process, which is going to be a great thing because carriers want to simplify the process, make it easier, make it less expensive for them. Another thing that's changed is policy delivery. I delivered a policy to a client last week where I got a link from the carrier, and then all of the signatures for the delivery requirements could be done electronically. And then after that was done, I actually had a Zoom meeting with the client walking through the policy where I had highlighted the areas that I wanted to make sure the client understood. So there are efficiencies being built into the process because of the pandemic that after the pandemic's over, it might be a real positive. In the Wall Street Journal article, Leslie pointed out that there are limitations on older age clients getting coverage. Some of the carriers out there are postponing the offering of coverage until the pandemic is over, or at least they can get a feel for and see the end of the pandemic. And for all clients, there's more review of travel. Now, I think that this is diminishing now that everybody's back in the US and we're pretty much huddled down for a while. But initially, when this started, they really wanted to know where you were. And if you were in one of the places that the CDC had deemed as being very risky, you had a real issue. So if we look at the carriers, three things. One, mortality is not an issue. Two, underwriting has been made easier and simpler, hopefully, going forward because of what they've learned through the pandemic. But the third thing is the real concern with the carrier when you talk to the executives is economic. That's the real issue. And if you think back, for those of us who remember 2007, before the last crisis we went through, you could walk into any bank in the United States and you could get a certificate of deposit for 5% guaranteed. It's amazing to think about that, but that's what you could get back in 2007. So the question is, 3 years from now, if you walked into a bank, would you get over or under 3% with a CD? Right now, I think it's about 1.5. The question is, are we going to stay at these low interest rates, or are we going to have interest rates tick back up? Because this is really, really critical for fixed investors. And the number one fixed investor are insurance companies. Larry Fink, who's the CEO of BlackRock, the largest investment house in the world, in 2015 said persistent low rates are destroying the viability of insurance companies. In 2016, Evan Goldberg, who was CEO of Chubb, still is, said the current environment is unsustainable and that many companies are losing money now and many will lose money in the future. Now, both of these gentlemen said this after 6 or 7 years of very, very low interest rates. On your screen is the daily effective federal funds rate, the Fed funds rate that everybody talks about all the time. And in 2015 and 16, we had been through 6 or 7 years of these incredibly low rates that began to tick back up. But into 2019 and 2020, they leveled out until we hit the pandemic, and then they dropped down. So the interest rates right now, the federal funds rate is effectively zero. It's 0.25, with people now talking about a negative interest rate for the federal funds rate. So right now, we have the lowest interest rates in history. And I'm not talking about the history of your life or the history of my life. I'm talking about the history of the world. So this is a huge issue in the marketplace, and this plays a big effect if you're a trustee managing life insurance. So how is this going to affect you, and how should you be reviewing your policies going forward? Well, first of all, understand that policies have been stressed for over 10 years now. So we may be focused on the pandemic, but this has been going on for over 10 years. So you have to be more vigilant than ever if you're managing a life insurance policy. And to lessen your liability, you have to look forward. You have to be able to see issues in the policy before they come up. You have to manage client expectations and make sure your clients are aware of any issues that you see down the road. And that's what we're going to talk about a little here. So for every policy that's in your portfolio, first thing you want to do is you want to review the policy against prior expectations. What do I mean by that? What were the assumptions when the policy first came in, when the policy was taken out? Is the crediting rate or the dividend the same, or did it, because it's not the same, it went down? What effect did that have on the policy? As for reviewing the policies going forward, you need to make sure that your expectations around the policy assumptions are reasonable. Do you see the rates improving? Do you see the rates staying the same? If you bring a policy into trust, what are the expectations on the sales illustration? And we're going to talk about this a little bit more later. So let's take a few minutes to review the different types of life insurance policies in your portfolio, point out some things that are affecting the policies, and some things you should keep an eye on. I want to give you some tips that could help you out as you move ahead. And we're going to start with whole life. The cash value in whole life policies is invested primarily in fixed investments like corporate bonds and other high-grade fixed assets, which is why when we look at dividends, we tend to compare them against what's called the Moody's AAA bond index here, the bottom line here. Dividends tend to run a bit higher than the Moody's bond index. The blue line is the top 14 carriers' dividends versus the line below it, which is the Moody's bond index. So one of the things to point out is at the end here, the spread between the bond index and the dividends it's a little wider than it has been in a while. So how is that going to affect dividends going forward? Without higher rates, can dividends stay where they are, or are they going to fall? Another variable in this equation, carriers invest in these fixed investments, but they also invest in mortgages. So how will the real estate market hold up? We see right now a lot of big companies teetering on bankruptcy, a lot of big box stores teetering on bankruptcy. A lot of companies are looking at the fact that you all are staying home and thinking, hey, maybe we can save money if we have less people come into the office. So how is all of this going to affect real estate going forward? Because these are some of the lingering questions when you're dealing with whole life dividends, and you have to look ahead and see what is going to happen in the marketplace. But obviously, dividends are down now. They are historically low. So what does this mean? What should you be taking a look at? Well, first of all, if you have policies in your trust that have term blends, you need to take a look at them, because whole life is typically it's blended with term insurance to lower the cost. And the idea is that over the life of the policy, the term insurance is converted to base whole life by use of the dividends. So if the dividends drop, not all of that term insurance is converted over to base whole life, and you can have an issue in the older age. So for example, I'm reviewing a policy right now for an attorney. It's 8 years old, $2 million whole life policy. It has $1 million of term insurance in it. When the policy was issued 8 years ago, the term insurance was projected to convert completely 100% to whole life by maturity. Now, 8 years later, at age 92, that term insurance has not converted. It begins to drop off because it's too expensive and the dividends can't pay for it. So the client has a choice of either dropping that death benefit or paying more. So the thing you want to focus on here, and what I told the trustee, you have to be aware of this and monitor the situation. You don't have a huge problem as a trustee, but you should let the client know maybe the dividends are going to increase, maybe not. You can't control that, but you can control the client's expectations. You need to monitor policies with loans. Any loan that grows too large can cause a policy to lapse, which can cause a taxable event. And if your client doesn't have the premium to pay for this year's policy premium, review your automatic premium loans and your dividend options with the carriers, so you make sure that the policy is taken care of this year. The second policy to talk about is the current assumption universal life contract. And when these policies were taken out, first came out in early 1980s, the interest rates were extremely high. Here's the interest rate, the actual interest rate on a current assumption product that came out in 1986. The interest rate projected at policy issue was 11%. The policy never saw that 11% and is actually right now paying the guaranteed rate of 4%. Now, newer policies are not going to have such a dramatic difference, but the crediting rates have dropped. And if you look, you'll see that many policies in your portfolio are at the guaranteed minimum rates that the carrier is obliged to pay. And that brings us to something that you need to keep your eye on. What do these carriers on your screen have in common? They all raise the cost of insurance inside their current assumption universal life products, doubling and even tripling the carrying costs on the policies overnight. You see, carriers make money on what's called the interest rate spread. The carrier goes out and earns 5%, credits the policy for 4%, and they make the difference. Now, if the carriers, because of interest rate compression, can't make money on the interest rate spread, where are they going to make that money? Well, they can make it up by raising the cost of insurance inside the policy. And we had a rash of cost of insurance increases in the past years. And I have a feeling that with this drop in interest rates again, we may be in store for some more. So be prepared and watch out for the cost of insurance increases, and be prepared to develop options for your clients. You're going to have to review all of the options, including going back to the market if the client is healthy and attempting to get a more efficient product, because the COI increases are going to make that product much, much more expensive. The good thing about a current assumption universal life product without any type of death benefit guarantees is that the premiums are flexible. So if your client cannot pay the premium, which maybe they can't this year, they'll be glad to hear that they can skip a year's premium. But if you do skip a year's premium, go out and get an in-force illustration to see what that does to the policy, and make sure you document that for the policy, for the trust. Guaranteed Universal Life, or GUL, is a completely different product than the current assumption product. This type of policy has a guaranteed death benefit no matter what happens in the marketplace, as long as the premium is paid in full and paid in time. So with this policy, what you want to do is year to year, you want to track the death benefit and make sure it's still in force. Make sure it's still to the same age. If it was to maturity when the policy came in and you were late on a premium payment, that death benefit could drop to age 92. If you're late again, it could drop to age 84. So you need to track that annually. You want to give your client a longer time frame to pay on these policies, because they are required premiums. And if there is some sort of issue with them paying, you want to make sure that you have enough time to come up with creative ideas. For example, if your client has a $15,000 premium and can't pay it right now, look to change the mode to quarterly or even monthly, so that you can continue to pay what's required to keep the guarantee in force. Or if the client doesn't need as much death benefit, now might be time to look into what a lower death benefit costs. Variable universal life is is the one that's really taken the hit lately. And we focused on the equity markets, and variable life has the ability to invest in the equity markets, and the equity markets have been very, very volatile. So besides the fact you can invest in equities with this product and lose money, you as the trustee are the one managing the investment. You have total control over the investment. And so since it's been a bumpy ride lately, you want to keep your eyes on these policies for sure. And you want to review all of the variable life contracts, especially those with low cash value. And I suspect that any trustee on this call has already taken a look at that already. You want to focus on an age-appropriate allocation. In other words, you don't want the allocation to be too weighted in equities as the client gets older. And you can actually review the fixed account options, especially on some of these older policies where the fixed accounts were actually paying a pretty high guaranteed rate. So if you're an older client, you might be able to run it at the return of the fixed account, or at least a portion of the allocation can be to the fixed account to take some of the volatility out. And a good way to take the volatility out of the product is, and many products have this feature, you can pull the expenses from the fixed account. So if at the beginning of the year, there's $15,000 of expenses, monthly expenses coming from the policy, and you have $100,000 of cash, you can put the $15,000 in the fixed account, put the balance in equity accounts, and because the expenses are pulled from the fixed account, if the equity accounts go down, you're not selling shares when the account's down low. So look at that, the ability to pull the expenses from the fixed account as another method to take some of the volatility out of the product. Now on to index UL contracts, and these are very interesting products. They happen to be hot product right now. And the product is designed to capture a portion of the upside of the equity market or the index the product is invested in, but also have a downside protection with a floor. So for example, you could have a floor with a 0% return. So you're not going to lose money, and you'll have a cap that will float. And let's assume that the cap right now is 10%. You would get the return in an index between that 0% and the 10% cap. So these products, like I mentioned, are very, very, very popular right now. But I don't think that everyone quite understands how they work. And the fact of the matter is, interest rates have a big effect on these products, because the way the product works is a lot like a current assumption product, in that 95% of the premium goes to the general account, where along with the interest, it provides the floor. So for every dollar of premium, we put 95 cents in the general account, and we make 5 cents in interest. So at the end of the year, we have our dollar back. The balance of it goes to fund options. And so you take 5 cents of that dollar, and you use that money to purchase options on the index, which basically generates your upside potential. But two big issues we're seeing today is that the interest rate in the general accounts are down. And so because the interest on the interest rate in the general account is down, we have to put more money into the general account to get that 95 or 6 cents back to a dollar. So what does that mean? We have less money for the options budget. The other thing that is happening right now is we have a tremendous volatility, which raises the cost of the option. So you have this perfect negative storm, so to speak, where we have less money to buy options, and because of the volatility, the options are more costly. So what's happening is, you'll see, and it's happening right now, it's going to continue to happen, you'll see caps drop. So instead of 11 or a 10% cap, you might have a 9% cap. So this is putting pressure on index product returns, and that's going to affect anyone who's managing these products going forward, because in the past, when we first started seeing these products, we saw rates of 7 and even 8% in these policies. But because of the low rates and volatility, the assumptions on these policies are definitely dropping. Now, I've always felt that 7 and 8% was way too high to show, but right now you're probably going to be seeing agents showing you 6.5%. And no matter what rate of return you show for the policy coming in, I would suggest that you also show a 5% return, because I think that that's going to be more in line with what our expectations are. So the idea is you plan for a lower return, hope for a higher return, and if you do that, I believe your clients are going to be happier at the end. Because when we project the rate of return in a policy, whether it's a VUL policy or current assumption or an index policy, if we project a higher return, then we can project a lower premium needed to carry the policy. And that's great if I'm trying to make a sale. If I can show you an index product at 6.5%, the premium needed to carry that maturity is going to be less. Product the same if it's at 5, and that's well and good if that happens. But the problem is that just as when the rates go up, the premium need goes down. When the rate of return decreases, the premium needed in the policy is going to increase. So your client's going to wind up having to put more money into the policy, more money than they expected to put in the policy. So my suggestion is you be conservative when making projections on life insurance cash value returns, because to me, it's really all about managing client expectations. And that's going to lead to our next discussion point, which is a very important one. The one thing that you can do as a trustee is to manage expectations and mitigate your liability when the policy comes into your trust, because at that time, you set the tone for how the client is to be managed and how you're going to deal with the client. It's at this point where you can mitigate your liability dramatically as trustee. So let's talk about that a bit. When a policy comes in, make sure that you and the grantor have the same understanding about the policy and document that understanding. And the great thing is, for clients of ITM 21st, they do this when a policy comes in with what they call a statement of understanding. And you can use that document in this process because that gives you the information about the policy that everyone should be aware of. So to take a proactive approach, I'm going to suggest that you follow these steps when the policy comes in. And by the way, this is the part of the presentation where I really think the handbook comes in handy, because you can take this information with you and refer back to it when these types of issues come up. So what do you want to do when that policy comes in? The first thing you want to do is you want to review the illustration. You want to make sure that the returns are reasonable in the policy. You want to know how many years the client is expecting to pay the premium. You want to see if there are any multipliers or any other shenanigans in the policy illustration. I was looking at a index UL product the other day that showed a 5.92% return on the illustration, and yet the cash value return in the policy was over 6%. Now, how could that be that a policy where expenses are being taken out could have a higher return than the illustrated rate of return in the policy? And the answer is it had a multiplier built in that multiplied that rate of return. So you need to make sure that you understand what that illustration says. And if that illustration doesn't run to maturity, let's say you have a client that says nobody in my family lived past age 90 or age 91, and so that policy lapses at age 90 or 91, you need to go to the carrier and get an illustration that shows what they will have to pay should they be lucky enough to live to age 90 or 91, unlike anyone else in their family. And again, if you're a client of ITM 21st, you have the managed solution, they're going to do that for you, so you don't have to worry about that. The other thing you want to do is you want to be able to understand the policy. You want to know how the policy works. You want to know if the premiums are flexible or are they required. You want to know that the carrier is financially stable. You want to know if there's any caveats in the policy. You want to know what happens at policy maturity. Not all policies pay a full death benefit if your client should live to maturity. And guess what? More clients are going to be living to maturity in the future. And you want to make the grantor aware of their responsibilities. And I have a list in the handbook of the responsibilities that you can refer to, because this is very important. And don't be afraid to point out the responsibilities of the grantor clearly. If the policy has a death benefit that is guaranteed and needs a required premium, state that. And this is something that it's very timely today, because if you have a client who can't pay their premium on a required premium product, it would be good to have a document in the file that had been drawn up when the client came to you that said that they understood that the asset in the trust requires a timely premium payment, and you're not going to be responsible if you lose the death benefit guarantees because of late or inadequate gifting to the trust. People have a tendency to not remember things like that, so it's good to document it. So one of the things I want to bring up too is it's very, very important that the client has a policy that fits them. And there's not a best policy for everyone, but there is a best policy for the client, and that's based on their personal situation. And if you understand the characteristics of life insurance and you match those characteristics to your clients, you can go a long way to making sure they have the right policy in their trust. And I know there may be some agents on the line that say, look, there's a lot more that goes into this than this, but there's underwriting, product design, et cetera. But what I'm trying to do here is I'm going to show you 4 characteristics that you can review that can help you understand whether or not the policy is right for your client. It's important that you do when the policy comes in. So there are 4 characteristics to review. The first is premium flexibility. Does the policy have required premium, or is it flexible so you can skip a premium payment or pay less, etc.? This cash flow is important when you're dealing with funding a life insurance policy. What is the investment risk? Is your client purchasing a policy that's invested in the equity market, like a VUL policy, subject to volatility? Or do they have a product like a guaranteed UL product that has no investment risk? What is it that your client needs or wants? Is there cash value growth in the policy? You know, in the trust-owned life insurance world, it's typically not that important to have cash value. It's more about the death benefit rate of return. But maybe there's a reason for that cash value. And certainly it's a reason to have a discussion. And then the last is the death benefit guarantee. If you buy a guaranteed universal life policy, you're going to have the death guarantees, but other universal life policies don't have any death benefit guarantees. So there's a lot to discuss. And in the handbook, I have a series of questions so you can work your way through the discussion with your clients, because you can then fit the policy to your client. And I know many of you who are trustees are not there at this product sale, but it's good for you to understand the policy characteristics so that you can understand the policy and help your client when you're managing the policy. You don't have to be an expert to understand life insurance and help your clients. And I'm a big believer in processes for life insurance, especially in the TOLI world. And that brings me to the last point I want to make to close out this session. And I bring this up because too often I've seen situations where trustees could easily get in hot water. And that is when clients call and ask for a policy surrender or policy modification. Last week, John Barkhurst talked about clients of ITM 21st saying that they had clients, grantors calling and asking for policy loans, asking to surrender the policy. And I think because of the pandemic and the economic downturn that we are just starting, I think it's going to get worse. And I think that you're going to be getting a call or two from clients who are looking to surrender a policy. So the number one thing that's important is that before you lapse or surrender a policy, that you reach out to the beneficiaries. And you want to ask the beneficiaries if they want to fund the policy, if the grantor is not going to. You don't want to surrender a policy without having reached out to the beneficiary. That could be a big issue. And again, what I'm going to do is walk through a simple process for you to maximize the value of the policy and provide better customer service to your clients. So here's 7 simple steps to walk through to review a policy. The first is, if your client wants to surrender a policy, go to the carrier and ask them for an illustration that says, what happens if I leave the death benefit in place but don't pay any premium? And see how long that policy will last. It's typical that it's not going to last to maturity or even life expectancy. But the second thing you can do is ask the carrier, if I reduce the death benefit down lower than it is, how long will this policy last? Can I get a policy to last to maturity or to life expectancy? Because that might be a good option for the client. The next thing, so if you surrender the policy, make sure you review the tax consequences. Your client's going to pay, or the trust is going to pay taxes on the difference between what you receive and the premium that you've paid out, or the cost basis in the policy. The fourth thing, it may be your client is just tired of the existing policy. Maybe it had a cost of insurance increase. Maybe it hasn't performed. Maybe there's a more efficient policy. And I'm going to give you a resource at the end of this, an article that gets into detail on this. And it as one example, shows a 70-some-year-old couple who got a much more efficient policy by going back to the marketplace, which is one of the options that you should check. Another option is exchanging the policy for a policy with other benefits. Your client may not need the policy anymore for estate planning, but maybe they don't need to protect their estate at death. They need to protect it during their life. So maybe a policy with long-term care benefits makes sense for them now that they're getting older and they're worried about long-term care benefits. The last thing I want to talk about is selling the policy. And as Leon mentioned, we're going to do a whole session on life settlements. And that is one option that if you as trustee have to take a look at. So it may not be for everyone. As a matter of fact, only 25% of policies are even viable in the life settlement marketplace. But if you're a trustee and you don't look at this option, you could be found to be liable. The last thing I want to talk about is let's make the assumption that you've gone through these 6 steps, and the best thing to do is probably to surrender this policy. You want to make sure that instead of surrendering the policy or allowing the policy to lapse, that you maximize its tax benefits. And let me give you an example. Let's say you had a policy, a current assumption universal life policy, where your client put $10,000 in every year for 25 years. So the cost basis in that policy would be $250,000. If they surrendered the policy and then put that into an investment, the cost basis in that investment would be $10,000. But if they did a 1035 exchange of that policy to, for example, an annuity, the cost basis in the annuity would be $250,000. So instead of having an investment with a cost basis of $10,000, they could have a cost basis of $250,000. You would have a cost basis in a new investment that's $240,000 greater. So you've gone through this process. You've shown them that you've looked at every option for this policy that they wanted to surrender. Maybe along the way, you got them a better alternative. But if you didn't, when they surrender, they're going to allow the policy to lapse. You gave them a much better idea than surrendering the policy. You gave them a much more efficient investment. And you did it by following a simple process that anyone at your firm could follow. So that's the positive aspect of this, providing good customer service. Now, I know that I went quickly through those 7 steps, and I wanted to, as I mentioned, give you another resource. And there's an article on my website that I wrote for Estate Planning Magazine that goes into the detail on these 7 steps so that you can figure out how best to go about maximizing the value of your client's life insurance policy. The last thing I want to talk about is something that is near and dear to my heart. I am sure that as I ran through this presentation, that there are people on this call that at least once during the presentation, they're a bit confused about something I said, because let's face it, not everyone is an expert in life insurance. I get that. So for those people, I put together a course for you. It's a simple way to gain the knowledge you need to help your clients. Leon mentioned the book I wrote back in 2019. I've taken that book and I've created 15 videos based on different chapters in that book. So the topics are listed on your screen. You can work your way through all of these different topics. In addition, if you sign up for the course, you will get a PDF version of the book. So what will happen is if you sign up at understandlifeinsurance.org, every Monday starting June 1st, you'll get a video that will provide that information for that week. And we'll go through 15 different videos. And by the end of it, you'll have a much better understanding of life insurance. I built this for wealth advisors and for trustees looking to get a better understanding of life insurance. And I think that if you have an organization, a bank, a trust company, a family office, a legal or accounting firm, like fantastic for an in-house educational program. So if you're interested, go to understandlifeinsurance.org and sign up. Like I said, it'll start June 1st. Don't go to .com. That takes you to, I think, Lincoln Benefit. This is understandlifeinsurance.org. So with that, I'm going to close it out and open it up for any questions that we might have.
Great, thank you, Mike. This is Leon. And John, you think we have some questions?
We do. We have a couple of questions. So I'll fire them out. We got about 5 minutes here to wrap it up. First question, and I'll ask this to you, Leon, because it is something that you and I have talked about even recently. It says, what is your opinion of trustees or co-trustees hiding under the cover of specific state statutes like PA, Ohio, etc., that state they have no responsibilities or liability with regard to evaluation of life insurance policies, as well as a position that they don't have any responsibilities to perform any type of Reg 9 reviews if a national bank or trust company on unique assets?
Wow, that's my opinion.
Yeah,
I
this
guess
is,
my opinion wouldn't be that good. So we have dealt with that. It's really started back in 2005, 2006. A lot of the banks and institutions that we worked with found their state legislatures or other persons within the state that were pursuing or have pursued or passed legislation that would protect the trustee against life insurance specifically, in many cases other unique assets, because it's really out of their wheelhouse. And so we've dealt with that. And I think, John, you and I both have a lot of clients from those states, like you mentioned, like Pennsylvania, Florida, North Carolina, Delaware, Ohio. There's a few others out there, South Dakota, where you can actually, shelter yourself from that investment responsibility and you will not have the liability associated with a failed policy. And, our clients have, for the most part, maybe with one or two exceptions, have chose to ignore that and to do what's best for the client. And so, I think it's great for the institution. If you're in those states and you have that practice, I think your liability is certainly limited. I don't think it's very good for the customer, because as they get older, when these instruments have a tendency to need the most care and special handling and likely to fail, then they really are lost and they don't have the resources there to help them. And so what has been probably one of their largest investments during their lifetime, goes down the drain because they did not have good oversight, good management. So good for the institution if you're in those states, bad for the customer if you're older and don't understand life insurance.
any other questions?
Yes, one more question, Mike, and it's a follow-up to a point that you hit on as one of the options when evaluating prior to surrender. And it says, given that a trustee's primary duty is to the beneficiaries, any thoughts on converting a life insurance policy to a hybrid life insurance policy / long-term care policy within the ILIT?
Yeah, so I think that's something you're going to see more often going forward. It's my understanding you need an indemnity type policy. But like I said, I think that one of the issues going forward for beneficiaries that will make it so they would be amenable to that would be that they're worried about protecting their clients' assets during lifetime. And if you had this asset in the trust, that especially if you had a larger death benefit, you have a $3 or $4 million death benefit, and you're going to reduce it down to a $1 or $2 million death benefit with long-term care benefits, that might be an option that is going to become more attractive for people. Any other questions?
That's those were the two that were submitted.
Okay, great. Okay, so I wanted to also mention that our next session is with Judy Pearson, Maximizing Liability in a Changing Market. And I met Judy when we were both doing a presentation at the ABA, and I followed Judy, and she did a terrific job, and she's going to be awesome in the next presentation. So I hope everybody takes advantage of that presentation. If anybody has any questions about anything I talked about today or anything dealing with life insurance, my number's on the screen, and I invite you to contact me. Thanks a lot, everybody, and we'll see you next time.
All right, well, that will do it for today. Thanks, John. Thanks, Mike. For those of you that want the continuing education credits, don't forget to get those forms into us within 7 days. Joe Gausted will help you if you have questions. If they come in incomplete, we'll try to get it back to you to get completion and submitted. Other than that, comments are always welcome, and we look forward to seeing you in a couple of weeks. Take care, everyone.